Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Microsoft.
And folks, we are not just looking at a tech giant today. We are stripping away the noise around the world's most valuable company to look at a number so big it almost doesn't feel real.
Right.
We're talking about a $625 billion safety net.
Exactly. That is the headline number everyone is whispering about or, shouting about, depending on who you listen to. That $625 billion in remaining performance obligations. RPO. Is essentially an AI flywheel that's currently larger than the entire market cap of most companies in the S&P 500.
It's absolutely wild. But before we unwrap how a company even ends up with a backlog that big, if you find our talks useful, please consider subscribe, like, and comment underneath. It helps us keep the lights on and the analysis coming.
So let's get right into it. We should probably start with the fundamental beat. We're looking at the Q2 fiscal year 2026 report.
Okay, lay the raw numbers on me. What did the scoreboard say?
Well, it was a decisive win. Top-line revenue came in at $81.3 billion.
It's 81.3.
And to give you some context, consensus expectations, what all the Wall Street analysts thought would happen, was $80.3 billion. So Microsoft beat that by a full $1 billion.
A $1 billion beat. For a startup, $1 billion is, well, that's the dream exit. For Microsoft, it's just the amount they exceeded expectations by in one quarter.
I know.
That really sets the stage for the scale we're dealing with here.
It really does. And the profitability held up, too. Earnings per share, or EPS, that landed right near the consensus of $3.92.
Okay.
But where it gets really interesting is when you look under the hood at where that money is actually coming from. Because if you just look at the top line, you miss the transformation that's happening inside the company.
Yeah, and I'm guessing we're talking about the mix shift toward the cloud.
We are absolutely talking about the cloud. Azure growth was the star of the show. It clocked in at 39% year-over-year growth.
39%.
39. If you adjust for constant currency, it's 38%. But either way, that is just massive acceleration for business of this size.
That is what always blows my mind. Usually, when companies get this big, we're talking trillion-dollar valuations, growth slows down. It's just the law of large numbers, right?
Yeah.
You can't double an elephant as easily as you can double a mouse. But growing a core business unit at 39% at this scale, that is unusual.
It is. And it tells us something really important about the market demand. This isn't just organic growth. This is an injection of AI demand that is it's distorting the normal laws of gravity for a company this big. And it's not just Azure. The broader Microsoft Cloud category, which wraps up all their commercial cloud offerings, total revenue there reached $51.5 billion, up 26%.
So basically half the company is now just the cloud.
Pretty much. And even the boring stuff is accelerating. The productivity and business processes segment, so think Office, LinkedIn, Dynamics growth there accelerated to 17%.
17% for the Office segment.
Yep.
Yeah.
Largely driven by people upgrading to Microsoft 365, likely to get their hands on all those new AI features.
That's a fascinating point. I feel like we often overlook Office because, it's been around for 30 years. But growing that legacy segment at 17%, that suggests people aren't just renewing, they're upgrading.
They're buying the premium ticket.
Yeah.
Exactly. It's a bit of a Trojan horse strategy. You're already using Word, you're already using Excel. So upgrading to get Copilot to write your drafts or analyze your spreadsheets, it feels like a natural step, not like a whole new purchase. It's very sticky.
Okay, so the report card looks great. Revenue's up, cloud is zooming, legacy software is growing faster than it has any right to be.
Right.
But you teased this monster number at the beginning, this $625 billion. Let's unpack this. What exactly is remaining performance obligations?
Think of RPO as a backlog. It's revenue that is under contract signed, sealed, legally binding, but it hasn't been delivered or recognized on the books yet. It's future money that is already promised to Microsoft.
So it's like, if I hire a contractor to build a house and we sign a contract for $500,000, but they haven't started laying bricks yet, that $500,000 is in their RPO.
Exactly. Now imagine you have a backlog of $625 billion.
That is a lot of houses, a lot.
It's a 110% surge year over year,
If
more than doubled. And this is the why that matters. This isn't just companies buying Windows licenses for next year. This is driven by massive multi-year commitments from partners like OpenAI and Anthropic.
Wait, OpenAI?
Yes. In fact, the analysis shows that OpenAI commitments make up 45% of that entire RPO figure.
Whoa, hold on. Almost half of that $625 billion backlog is tied to OpenAI. That implies a level of partnership or, dependency that I don't think most people realize.
It does.
Doesn't that scare you a little bit? That's a massive concentration of risk in one basket.
It is a valid concern, and that's the bear case for sure. If OpenAI stumbles or if regulatory issues hit them, that backlog could be at risk. But flip it around. It effectively means Microsoft has locked in the infrastructure spend for the leading AI players for years to come. It creates what investors call durable cash flow visibility.
It's a floor.
It is. We know for a fact that 25% of this $625 billion will be recognized as revenue in the next 12 months.
Yeah.
That's a floor of revenue that is virtually guaranteed.
It's a safety net. No matter what the economy does next week, recession, inflation, whatever, they have hundreds of billions of dollars effectively queued up in the bank.
Right.
That decouples them from the immediate economic cycle in a way that very, very few companies can claim.
Precisely. And that visibility is why the guidance for Azure in Q3 is remaining so strong. They're saying 37 to 38% growth, even though they're facing some serious constraints on how much hardware they can actually deploy.
Which brings us to the other side of the coin. You can't build a $625 billion backlog of AI services without building the actual computers to run them. And that costs money.
A lot of money.
A lot of money.
It certainly does. And this was the sticker shock moment of the report. Microsoft spent $37.5 billion in capital expenditure CapEx in a single quarter.
$37.5 billion in 3 months. That's,
Yeah.
That's the GDP of a small country.
The 66% increase year over year. And usually, Wall Street hates this. Investors get very, very anxious when they see spending balloon like that because it eats into margins.
Right.
They worry. Are you burning cash on data centers that you won't be able to fill? Is this just an arms race with no winner?
Right, the field of dreams strategy. If you build it, they will come. But what if they don't? Or what if they come, but the electricity and chips are so expensive that it costs you $2 to make $1? That's the fear of profitless prosperity, isn't it?
That's the fear, exactly. But here is the expert rebuttal, and why the sentiment remains bullish despite that spending. The demand right now is supply constrained.
Meaning they physically cannot build the servers fast enough to give customers what they want.
Exactly. The analysis suggests that Azure could likely grow faster than 39% if they just had more capacity.
Wow.
So they aren't building a field of dreams hoping for players. The stadium's already sold out, and they are frantically trying to add more seats while the game is already being played.
So every single dollar of that $37.5 billion is essentially already spoken for.
Pretty much. And they are getting smarter about how they spend it. They aren't just, buying NVIDIA chips off the shelf blindly. They're using operational efficiencies in what they call their fungible server fleet.
Fungible. That's a great word. What does that mean in the context of a data center?
It basically means interchangeability. So in the old days, you might have had a server rack dedicated to email and another one dedicated to database storage.
Right.
If the email rack was busy but the storage rack was empty, well, you couldn't swap them. Now they are building architecture where capacity can be swapped instantly.
So if they need to train an AI model today, they use the capacity. If they need to run a Bing search tomorrow, they use the exact same capacity.
Exactly. It prevents stranded assets. It ensures that the hardware they buy is being utilized almost 204/7.
Yeah.
Plus, they're deploying their own proprietary silicon, the Maya, and Cobalt chips.
Making their own chips. Relying less on others, that has to help the margins.
It improves their margins significantly. There's a metric mentioned in the analysis called tokens per watt per dollar. It's a bit of a mouthful, but it's the holy grail of AI economics.
Break that down for us.
Well, AI runs on tokens, pieces of words or code, and generating those tokens takes electricity, which is watts, and hardware, which is dollars.
Okay.
If you can generate more AI tokens for less electricity and less money, you win.
Yeah.
And Microsoft's custom silicon is helping them optimize that equation better than almost anyone else right now because they control the whole stack.
So they are spending a fortune, but they are doing it because they literally can't keep up with people trying to give them money. That sounds like a pretty good problem to have.
It is. But it's not just about the hardware infrastructure. We have to talk about the software adoption. Because the moat here isn't just big data centers, it's the products people use every single day.
Right, the things we actually see on our screens. How is Copilot doing? I feel like I see that little icon everywhere now.
You do, and so does everyone else.
Yeah.
Copilot adoption has reached 15 million paid seats. That is a 160% increase.
15 million people paying extra for the AI assistant. That's starting to become a real business, not just some science project. And presumably, these are high-margin subscriptions.
Very high margin. Once the model is trained, the cost to serve the next user is relatively low compared to the subscription price. And then there's Fabric.
Fabric, okay.
This is their data platform. It might sound a bit technical, but it's crucial for companies trying to organize their data for AI.
I have heard of Fabric. It seems like the plumbing that has to happen before the party can even start.
That's a perfect analogy. If you are a big enterprise, say a bank or a retailer, you can't just plug AI into a messy database. Fabric cleans and structures that data. It has exceeded a $2 billion annual run rate and is growing at 60%.
$2 billion from a product most people on the street haven't even heard of. That really highlights the depth of their ecosystem.
And that ecosystem is the moat. We call it the integrated AI cloud ecosystem. Think about it. If you're a big enterprise, you probably use Office. You probably use Azure. Now use Fabric for your data and Copilot for your staff. The switching costs, the pain of leaving Microsoft are incredibly high.
You're locked in, but I mean, it's in a golden handcuff sort of way. You don't want to leave because everything just works together so well.
Right. They have 70% enterprise penetration. And their net score for Azure is in the mid-40s, which is excellent. They aren't just retaining customers, their customers are actually happy.
So how does this stack up against the competition? I mean, Amazon and Google aren't exactly sitting on their hands. AWS is massive.
No, they aren't. Amazon's CEO has claimed AWS is the cloud leader, and Google Cloud is closing the gap technically. But Microsoft has a specific strategy here. Because they have their own apps, like Copilot, they can prioritize their scarce GPU resources for high-margin SaaS.
Oh, I see. So instead of just renting out the raw computing power to a startup for pennies, they can use that same computing power to run Copilot, which they sell for a premium subscription.
Exactly. It's a higher value per chip. That's the defensive flywheel. They can make more money from the same NVIDIA chip than Amazon can, simply because they have that software layer on top of it.
That makes perfect sense. Okay, so we have a revenue beat, a massive backlog, supply-constrained demand, successful products, but, and here's the paradox, the stock dropped 10% following the earnings report.
It did. A sharp correction.
If everything is so rosy, why did the market throw a tantrum?
This is where market psychology comes into play. You have to remember, expectations were sky high. Microsoft was trading at a high valuation. When you are priced for perfection, even a great report can lead to a sell-off if it isn't perfect enough, or if that CapEx number scares people.
So it's the sell the news phenomenon?
Partly. There's also a broader tech sell-off context. Dan Ives, a prominent analyst, described the recent software sell-off as the worst he has seen in 25 years.
Wow, since the dot-com bust.
Essentially. He notes that the market is just punishing software stocks brutally. Yet he keeps a bullish stance on Microsoft because of the AI relevance. But there is a lot of fear out there. There are bearish sentiments regarding the bond market blowback.
What does that mean?
It means that this AI arms race, this spending of hundreds of billions on infrastructure, might trigger issues in the bond market. If companies borrow too much, or if the spending fuels inflation, interest rates might stay high. And high interest rates are just bad for tech stocks.
So the drop wasn't necessarily because Microsoft did something wrong, but because the market is just nervous about the cost of the AI revolution in general.
Correct. It's a macro fear. But despite the drop, the strong buy rating persists for most analysts. The argument is that the RPO momentum, that $625 billion safety net, suggests that this dip might actually be an entry point.
A discount on a Lamborghini, essentially.
That's how the bulls see it. They see the sell-off as short-sighted.
So let's look forward. We're in Q3 now. What's on the calendar? What should investors be watching for?
The next big catalyst is the Q3 earnings report, expected in late April 2026. The guidance suggests Azure growth of 37 to 38%.
So holding steady at that very high growth rate, no signs of slowing down.
Yes, but there's a speculative catalyst that is even more interesting. There are hints from management about a shift toward agentic AI architectures.
Agentic AI. That sounds like sci-fi. What does it mean in plain English?
So far, we've had chatbots. You ask a question, it gives an answer. It's passive. Agentic AI means AI agents that can actually do things. You get a goal, plan a travel itinerary, and book the flights. And it goes and executes the task across different systems.
Moving from a chatbot to a do-bot?
I like that, yes. And this could lead to a shift in pricing. Instead of paying per user per month, like a gym membership, you might pay per token or per outcome.
So if the AI saves me 10 hours of work, I pay a fee for that specific outcome.
Exactly. That would be a completely new monetization model. It moves AI from being a helper to being a digital employee.
That sounds incredibly lucrative if they pull it off, but it also sounds complex. Is the technology actually there yet?
It's getting there. And that's what investors are watching for. If Microsoft can prove that these agents work reliably, the value of their software goes up tenfold. But we have to be balanced here. What is the biggest risk? What keeps the bears up at night?
Right, let's look at the downside.
The main fear is the CapEx decoupling risk. Basically, the fear that they keep spending $37 billion, $40 billion a quarter on infrastructure, but the revenue growth doesn't keep pace. If that gap widens, margins get crushed.
Spending billions and waiting too long for the return. The classic indigestion of overinvestment.
Right. But the defense against that is the supply-constrained argument we discussed. Demand is projected to exceed 40% potential once the infrastructure catches up. As long as the customers are banging on the door, the spending is justified.
It sounds like a high-stakes poker game, but they're holding a straight flush.
That's a fair assessment. They have the cards.
So bring it home for us. What is the final verdict on Microsoft right now?
Based on the analysis, the score is a bullish 9-10.
9 out of 10. That is high confidence.
It is. Here is the elevator pitch. You have a $625 billion RPO, essentially a guaranteed future revenue stream. You have 15 million people paying for Copilot. This creates a flywheel effect. The recent 10% sell-off is viewed largely as a psychological reaction and a buying opportunity for a multi-year hold.
So ignore the daily noise, look at the backlog, and think in years, not weeks.
Exactly. The time horizon here is a multi-year hold, at least looking into the Q3 earnings to see if that Azure growth holds up.
It's a compelling case. When you see a company this size acting this nimble, it's frankly scary for the competition.
It is. The scale combined with the speed is the defining characteristic here. They are moving faster than startups, but with the bank account of a nation-state.
Before we wrap up, what is the one thing, just one thing, the listener should keep their eye on in the next few months?
Watch that agentic AI transition. Listen closely to what Satya Nadella says about agents in the next few public appearances. If that technology accelerates, it changes the monetization model completely. It moves AI from a tool you use to labor you hire, and that is worth a lot more money.
From tool to labor. That is a wild thought to end on. Microsoft isn't just selling software anymore. They're selling digital work.
That's the future.
Fascinating stuff as always. Thank you for breaking it down for us. And to everyone listening, thanks for tuning in to Smart Wealth with Joshua. We'll catch you in the next one.